If you want an even more aggressive strategy, this is how you want to use candles and candle patterns to enter into divergence trades. Okay, when we see a divergence developing, the most aggressive way to enter into the market is after a reversal candle or pattern. This is even more aggressive than the trend line strategy we just showed. Now keep in mind that these will have a higher rate of failure. However, using this entry strategy properly will cut down on some unnecessary losses. So let's talk about how to properly use candles. Make sure price is reacting to a key level of support or resistance where the candle or pattern was formed. This basically goes for every strategy we teach. We want to see our setups at key levels of supply and demand. Okay? Now, there must be a significant run in price into that key level before the candle or pattern is formed. We talked about this earlier in the candlestick section. Okay, candlesticks have absolutely no meaning in a sideways consolidating market where traders are just chopping wood. They just don't mean anything. Okay, so do not enter in sideways or consolidating markets. The way you want to enter, once you see all of these factors, place a buy or sell stop 3 to 5 pips above or below the candle or candle pattern. Very similar to what we just talked about with the entry method using the trend line. Okay, we're not going to enter right when the candle's formed. We're going to let the market follow through a little bit and bring us into the trade by breaking the high or the low of that candle or the pattern. Place your stop just above or below the candle or pattern formation. Now, as you can imagine, this can give you some really good reward to risk ratios because now you're not really waiting for a run in price to break a trend line. You're just looking for that candle pattern and for price to follow through, break that candle formation to the side you want to trade, and you're going to place your stop above that candle, but your target here is going to be the high or the low point between the swings that diverge. So we're using the same target method as we use for any other divergence. Okay, we're targeting that higher low point between the points that diverged. Okay, and as you can imagine, this allows for some crazy reward to risk when you're trading this method. All right, but also keep in mind you're going to have more losses like this because you're going to have more false signals. That's just how it goes. Okay, so let's go ahead and have a look at some charts here and see how this can work in the real market. Okay, so here's the Aussie US dollar, and we're going to look right here at this divergence. Now we're going to assume that this is a level of resistance in the higher degree time frame because right now I don't have a way to actually show that. So we're going to assume that fact, and that's one thing you want to make sure before you enter into any trade. But we'll have price moving higher. Okay, we have the MACD here cycling lower. Okay, so we have our divergence. We have a run up in price, and then look at the candle pattern here at this divergence level. First we have this doji candle. Okay, so an indecision candle, and then we have a very bearish following candle. This is a bearish candle pattern here. Okay, it's not an individual candle, but a candle pattern. So we'd want to put our entry, and we'll just get our little tool over here, our short position tool, and we want to put the entry, we'll say 3 to 5 pips below that low. So we'll say 77.17. Let's just take it down to, we'll just take it right there, 13.8, close enough. Okay, so that's where we want to put the entry. All right, now, what do we want to do next? We want to make sure that our reward to risk is good. So we'll put our stop above the high, and we want to target this low. This is our target, the low point here between the points that diverged. And what's our reward to risk? You see right here on our positioning calculator, it gives us a 2.12 to 1 reward to risk. Okay, so a good reward to risk. Now, if you were to use the trend line strategy on here, that wouldn't have worked out quite as well. Okay, so you can see how entering with the candle pattern here is a bit more aggressive, but you'll get a better reward to risk. Just to show this, if we were to draw a trend line on this, we would have had to have waited until this candle closed and the entry would have been much lower. The entry would have been down here. Okay, so if we adjust this to the entry level, would have been, let's see, the entry level would have been right here with break, had to been below this candle, so right about there. and the stop loss would have had to have been above the high, and the target would have been right there. So you can see, obviously, not a good reward to risk ratio. Okay, so not a candidate for the trend line break. You're risking more than you could have gained using the trend line break strategy. Okay, so let's go ahead and actually I'm going to go ahead and look again, maybe some more. There was another opportunity I wanted to look at over here. Yeah, and I wanted to show this because, you know, I want to show you what else can happen here. Now, here's another one. Okay, here's another one. This was a divergence, price moving higher, MACD, and let me actually, I need to increase the room that I have to work with here. There we go. MACD cycling lower here. Now, this is another reversal candle. We have an indecision candle and a very bearish candle here. Our entry on this would have been just below this point. So we would have entered right about here. Our stop loss would have been above that high, and our target would have been right there. So again, in this scenario, we have a 1.63 to 1 reward to risk. Not quite 2 to 1, but not bad. However, you can see what happened here. We came down a little bit here, and then rallied up, would have been stopped out. Okay, now I don't know if you would have reduced the risk here at that point. Probably not. Probably not at this point. More than likely this would have taken a full stop. Okay, but then again, right after that, we had another swing high. Let me just get rid of this. We had another very bearish candle develop here. And let's look at the entry from that point. So here was the low of that candle. We would have entered into the market right here. Okay, stop loss would have been above the high. The target at this point would be all the way here, and that would have given us a 2.1121 reward to risk ratio. Okay, and in this case, the trade worked out. Okay, so the first one here got stopped out right here, took a stop loss. Second entry, bearish candle, entered on the break. Okay, we did have a bit of a pullback here, so you would have had to have survived that, assuming you didn't take the risk out of this too quickly. This would have worked out and hit the target, targeting down at the low between the points that diverged. Now, here's the Euro 60-minute recently. Now, let's look at this. Pretty bearish looking candle here at the end of this divergence. Now, remember, we're looking at the entire swing. Okay, we have a divergence across the entire swing here. We were looking for price to react. We had a pretty bearish look right here. Let's look at what that would have brought us here. We would have entered after this bear candle right here, so about 5 pips below there. That would have been the entry. Target still hasn't been hit, but it would have been down here at this low. Stop loss just above the high. And this is what I mean by really good reward to risk. This is a 3.4 to 1 reward to risk ratio on this trade. And by this point, obviously you'd have had some of the risk out of this. You'd have had all the risk out of this. And probably some profits locked in here. Okay, so just an example of using just candlesticks at these levels more aggressively to enter into these divergent setups. Obviously, you're going to have more failed signals. You're going to take a few more stop outs more than likely. But as long as you're not over leveraging yourself and you're managing your risk properly, the other side of this should make that work out pretty well. Okay, because if you're taking rewards of 3.4 to 1, you're obviously going to do pretty good in this business. This is all about consistency. all about consistency. If you're getting reward to risk ratios like this and you're taking high quality setups, you could win 30% of your trades and still make money. So imagine what you could do at 50 or 60%. All right, and that's how you have to approach things. That's how you have to understand this business. Okay, it's a statistical business. It's not about being right or wrong. It's about taking high quality, high probable setups based on your edge, using good reward to risk ratios, using tight risk management. If you do those things, you will be successful. You will be successful.